I'm really pleased to tell you our speaker today is Michael Flowers, a distinguished attorney in the business law department of the law firm Steptoe & Johnson. He's located here in Columbus, in the Columbus office, but he works across 12 offices in 6 states around the country. And his legal practice is focused on general corporate, business, and commercial real estate law. He was recently named the firm's first Director of Diversity and Inclusion, and that allows him to assist the management of the firm to fulfill the firm's desire to make the firm open and welcoming to all. Before joining Steptoe & Johnson, Mike served as the Chief Legal Counsel for a privately held multi-state real estate development program. And he was in charge of legal aspects of the business activities and real estate projects for that company. Throughout his legal career, Mike has been active within the American Bar Association in a number of ways. He was former member of the Board of Governors of ABA. He was former chair of the ABA section of business law, and he's currently serving as special advisor to the ABA Rule of Law Initiative. And I'm really pleased to tell you that Mike was on the Board of Trustees of Columbus State Community College for 12 years. He's just recently stepped down from that position. And during those 12 years, in fact, just recently, Columbus State was one of 2 community colleges in the country that was named as the 2 best community colleges across the United States. Mike gave us his expertise to help Columbus State get to that position. So what was Columbus State's loss is Bucknell's gain. As he finished his time with Columbus State, his 12 years, he's now on the Board of Trustees of Bucknell University. And he also is serving as an appointed member of the Ohio Minority Development Financing Advisory Board. And he's a member of Ohio Small Business Advisory Council. Mike has had many honors throughout his career. I'll tell you about a few. He's been named as Outstanding Diversity Champion by Columbus Business First. He's received the Distinguished Alumni Award from Ohio State College of Law, and he's received the OSU Alumni Association Professional Achievement Award. And most recently, he was named by the Best Lawyers in America as the Columbus Area Lawyer of the Year for 2020 in the area of commercial finance law. What he's talking to us today about is in the news. In fact, you might have seen in the business section yesterday in the Columbus Dispatch, there was an article about his topic today, which is, Mike will be talking to us about opportunity zones and giving us an overview of that area. So Mike, it's my pleasure to welcome you. Please join me in giving a warm welcome to Michael Flowers.
Well, good afternoon, everyone. And Charlie, thank you very much for that very kind and generous introduction. I very, very much appreciate that, and I've really enjoyed working with you as I've gotten prepared to be the speaker today. I want to thank President O'Mara and the members of the Columbus Rotary Club for inviting me to be your speaker today. I've had the privilege of being your guest on many occasions. I want to thank my law partners, Bill Lane and Bill Wayhoff, for the many kind invitations they've given to me to come and join and be part of your proceedings. I also want to tell you that the time that I've been here at the Columbus Rotary Club, I've gotten a heightened and greater appreciation for the important work you do in our community, especially the work that you do with the Columbus City Schools and the Student Service Above Self program that you run there. I've been invited to attend those fairs where the students have put on their work. I've been so impressed by the positive impact that the Columbus Rotary Club is having on our Columbus City School students. And I want to commend you, and I especially want to commend the work of Rick Studer, who leads that work. on behalf of the Columbus Rotary Club. It's very interesting that today there's another organization that I'm involved with too that has an important tie-in, an important impact on our graduates of the Columbus City Schools. As I walked in today, I saw in the audience Steve Miller, who's the Area Development Director for the UNCF. The UNCF also impacts our region in a positive way because many of the Columbus City School students who leave Columbus City Schools go on to pursue their higher education at schools that are funded by the UNCF. I have the privilege of serving on the Leadership Council for Steve's initiative there, and I've seen firsthand, again, the impact of the lives of students who have benefited from UNCF funding. So I want to let you know that on February the 14th, UNCF is having their Mayor's Luncheon here in Columbus at QOZ. I hope members of the Columbus Rotary Club will find time to attend that luncheon, to support it, and to further, I think, which is really a joint mission of making sure Columbus City School graduates have the best and brightest future possible. So Steve, why don't you wave, make sure everybody knows where you are, just in case they want to get your card before we leave today. Good to see you, Steve. So our topic today, as Charlie indicated, is on the topic of opportunity zones. Opportunity zones are a federal program that has national reach, which is helpful for us at my law firm of Steptoe and Johnson because, as Charlie said, we operate across 6 states, a total of 14 offices. And this being a federal program, we have lawyers in all of our offices who are working on this important program. And it also, the fact that we have this big footprint is helpful to other lawyers in our firm who have other practices. For instance, my colleague Bill Wayhoff has a national OSHA practice, and our footprint allows him to conduct work on behalf of our clients that's across the entire footprint of our firm. Before I go too far, our general counsel at our law firm makes me put up this disclaimer. Obviously, every situation has different facts, different specifics, and there is no way one general presentation can address all those circumstances. So the information I'm going to share today with you hopefully will be informative, but it's probably not tailored to your individual situation. A quick outline of what we're going to try to cover here today. First, what in fact is a Qualified Opportunity Zone program? Why and how did this program come into existence? Secondly, what are qualified opportunity zones? Thirdly, what are qualified opportunity zone transactions? Fourth, what are the tax benefits for participating in a qualified opportunity zone transaction? And then finally, we're going to try to take a look at some of the technical requirements, and there are many, to participating in the Opportunity Zone program. Some of my colleagues have said that this whole Opportunity Zone program is the province of the U.S. Department of Treasury and its #1 subsidiary, the Internal Revenue Service. We do not understand why Congress would turn to the IRS to develop a real estate and commercial development program, but they did. And so what you see we have received comes from the IRS, and I said the IRS is best at separating money from taxpayers than allowing taxpayers to get their money back. So let's dive right in then. Let me do a quick survey first. How many people in the room, and I know we have some of the leaders in our commercial real estate industry here. I see Bob Weiler, Greg Shank, and others. So I know they know about this program, but how many others have a general familiarity with opportunity zones? Is this a topic? Good, great. This, I think, will hopefully allow us to have a good conversation about this, since it's something that's also, within the last year and a half, has been in the news. As Charlie mentioned, even as recent as yesterday, there was an article in the Dispatch talking about opportunity zones. Well, opportunity zones came out of the legislation, the Tax Cuts and Jobs Act of 2017, which the administration put forward and was able to get passed. Embedded within that massive piece of legislation was something called the Investing in Opportunity Act. And it is the centerpiece for opportunity zones. What it did was add two new provisions to the Internal Revenue Code, sections 1400Z-1 and 1400Z-2. 1400Z-1 established these opportunity zones. I'll talk about that in a moment. And 1400Z-2 set up the four primary tax benefits, the tax incentives that are at the heart of the Opportunity Zone program. As I said, the IRS was able to take these two small statutes and turn them into 544 pages of regulations. So we are, in the business and the legal community and the real estate world, trying to digest and make sense of these regulations. But generally, the whole thrust of the Opportunity Zone program came about because of a realization that not every aspect and community in our country had fully recovered from the Great Recession. There were many, many pockets and regions in our country that were still struggling from the effects of that downturn. Congress thought, after having some hearings, that one way we might be able to spur investment is to turn to the large number of unrealized and unrecognized capital gains that are sitting out there in our country. I think one estimate is that there are well over $1 trillion of unrealized and unrecognized capital gains. And in fact, the article that Charlie mentioned in the Dispatch yesterday estimated that so far, $6.72 billion of capital gains have been deployed in Opportunity Zone projects. So Congress seemed like they did find, in fact, a deep pocket of capital that was looking to be unleashed and now has finally found an opportunity to be redeployed. So those two things, let's try to address the disproportionate impact of no recovery in some areas. Let's tap into capital gains that are sitting on the sidelines with the main goal of driving private capital into low-income communities. I think this is very important because the dollars that are coming in through the Opportunity Zone program are not dollars that have been appropriated by Congress. These are funds that are held by individual private investors, and private investors have the ability to either use them or not use them. The other thing that this program has enjoyed so far is wide bipartisanship support. And as you all know, in this era that we're living in now, there aren't many things coming out of Washington, D.C. that enjoy wide bipartisanship support. And in fact, for us here in Central Ohio, at the time, former U.S. Representative Pat Tiberi was one of the lead sponsors of this legislation on the side of the House of Representatives. So what we're seeing here across the country, once again, has ties to our great state of Ohio. All right, then. So then, what is, in fact, an opportunity zone? Well, the way it works is that an opportunity zone is a census tract that has been designated as being eligible for these tax benefits that I'm going to talk about. In general, they are low-income communities, and they use the same definition for low-income communities that you will find in the New Markets Tax Credit legislation for those who you've had any familiarity with that. Typically, there's a 20% poverty rate or a median family income of less than 80% of the statewide median family income. Now, these opportunity zones were selected through a process that involved each state making recommendations up to the U.S. Department of Treasury. The way it worked, each state, each governor reached out to their local mayors, county commissioners, trustee townships, and asked them to say what parts of your community you believe meet this test and what part of your communities you believe will benefit from this program. As all of this finally bubbled up to the surface, our governor at the time, John Kasich, with his administration, made recommendations for the tracts that we have here in Ohio. Interestingly enough, only 25% of the nationally eligible income tracts and census tracts that met the definition were finally selected. So that lets you know the amount and the size of disparity that's out there in our country. Now, there's one thing that has caused a lot of media attention, and I ought to mention that right now because, again, that article in the Dispatch went to this point. The thrust of these tracts was to be toward low-income communities. But as the media has reported, there's a lot of activity going on in areas that most of us would agree are not necessarily low-income communities. The reason I see this and the way I believe that it happened is that embedded in the legislation that described what would be a low-income and a designated opportunity zone tract, there was an exception. Each governor was allowed to identify up to 5% of their tracts in areas that did not necessarily are low income themselves, but were adjacent to low income communities. The idea being that increased economic activity in an area that was sort of well on its way to development would have a overflow effect and hopefully have a spillover effect and help the adjacent low income community. So I think that is why you are seeing activity in areas that, to you and I, would say that area probably doesn't seem like it needs that stimulus, but yet it's still getting it. And so we're hopeful that Congress's wisdom of this spillover effect will yet be realized. All of these designations for low-income opportunity zone tracts will end in 10 years, in 2028. Nationwide, there are over 8,700 of these low-income communities that have been designated as census tracts for opportunity zones. We have 320 in our state, and right here in Columbus, we have 39. The one probably closest to us here, as we sit here today, is probably in West Franklinton, which is a short walk from where we're sitting. This map is just a map that I put up to show how they're dispersed across our state of Ohio. Those orange areas show where there are opportunity zones in our state. The good news is that out of our 88 counties, 73 counties have opportunity zones. So what that means, again, it shows that the economic disruption in our state is widespread. It's not really concentrated necessarily in one or two communities. The other thing is, if you have an interest in being involved in an opportunity zone, you're not limited to just Central Ohio. If your business operates in other parts of the state, there's a very good chance that there are opportunity zones in the region where you're also conducting other parts of your business. This is the map of Columbus region and our opportunity zones. As you can see, they are, again, fairly well dispersed throughout our central city area. They've been kind of, the mayor and his Department of Development have kind of grouped them in areas such as the Crosswoods area, up there just at 23 North and I-270. The Bush Boulevard area, over where the Continent exists, is an opportunity zone. The 315 corridor is also an opportunity zone. That might be, for us in our community, one of those areas where you may not necessarily have thought intuitively that there would be an opportunity zone. But it is there. Other areas are no surprise. The Eastland Mall area, the Westland Mall area, much of the Cleveland Avenue corridor, the Northern Lights area. These are all opportunity zones that have been identified by our community as places where they believe this reinvestment could have the most impact. All right, let's dig into some of the things that are important for understanding how opportunity zones work. First of all, what are qualified opportunity zone transactions? Well, there are three levels to each transaction. First of all, the taxpayer must be in a position where he or she is disposing of an asset that realizes a capital gain. It's important to stop there. If you don't have a capital gain to reinvest, this program has no meaning or use for you. This is not a program where you can take after-tax dollars and invest them in these areas and receive these tax benefits. It is limited to capital gains. The second level for this, a qualified opportunity zone transaction, is that the taxpayer has generally up to 180 days to invest in what's called a qualified opportunity fund. And we'll talk more about this, but generally, it's going to be a special purpose vehicle that you can set up yourself for the purpose of participating in this program. One important thing to remember as you go along is that the way the program is set up, you only have to reinvest the gain. So if you had a return that also included a return of your principal, you can put that in your pocket and still benefit and participate in this program by investing the gain. And then the third level of the requirements for a transaction is that you must timely invest in qualified assets located within one of these opportunity zones. So again, 3 levels of activity, 3 levels of requirements in order to begin your journey as a participant in a qualified opportunity zone transaction. So why would you want to do this? Well, these are the carrots. These are the incentives that Congress has put out there to entice people to take their capital gains and redeploy them in these communities that we've just talked about. And they really fall into sort of 2 buckets. On the left side, they deal with the realized gain. The first benefit is that your gain will be deferred. Instead of paying your tax today, Congress has said you can defer paying that tax to some future date. The outside date is December 31, 26. I think we all know the ability to pay a tax tomorrow is better than having to pay that tax today. So that's benefit number 1. The second benefit is that over time, the size of your ultimate tax bill is going to be reduced. If you stay in your investment for the first 5 years, Congress will allow you to reduce the size of the amount on which the tax will be computed by 10%. So if you had a $100,000 gain that would otherwise be taxable, after 5 years, you'd only pay tax on $90,000 of that gain. And if you're a little more patient, if you can wait 2 more years and go up to 7 years of holding that investment, Congress will allow you to reduce another 5%. So the tax bill that originally would have been paid on $100,000 will now only be paid on $85,000. That takes care of sort of the left side of what happens to the gain. On the other side, Congress has said, if you stay in that investment for 10 years, and that it has been a good investment for you and the investment has appreciated substantially, regardless of how much appreciation you receive on that, you will never pay any tax on that appreciation. It will be returned to you tax-free forever. So those are the bucket of incentives that Congress has put together to try to motivate those individuals with capital gains to bring those capital gains back into circulation into our economy and to make our communities better. There is an outside date, though, by which you must dispose of all your holdings, even after the 10-year holding period, and that is December 31, 2047. So, I'm a person who likes to learn things by example, so I put an example in here that we can walk through to see how this might actually maybe work in the real world. So follow the arrows. We start at the top row, moving left to right. Let's assume we have our individual taxpayer, Roger, buys a Picasso for his bathroom in 2008 for $1 million. In 2019, he's going to sell that important piece of artwork to his friend Joe for $11 million, thus generating a $10 million capital gain for our friend Roger. Roger then takes the $10 million in gain and decides he's going to open up a new travel agency via use of a qualified opportunity fund. So he's going to form this special vehicle that we'll talk more about to take advantage of the Opportunity Zone legislation. First of all, Roger gets to defer paying any tax on that gain while he puts his original $1 million investment in his pocket. So he's got the $1 million, and he's got no tax now on his $10 million gain. 5 years down the road, automatically, if Roger's still holding that investment, his $10 million gain that he would pay tax on, he now will only have to pay tax ultimately at some point on $9 million of that gain. Along the way, he's created, we hope, at least 50 new jobs and a new office space. Then now, moving further down the calendar, in year 7, Roger at that point will get that extra 5% reduction from the amount that he'll ultimately pay tax on. So at this point, he now only would have to pay tax on $8.5 million instead of the original $10 million. Company is still growing, 75 jobs have been created, and the office hopefully has expanded. As he moves forward in time on December 31, 26, it's the day of reckoning. Congress says, your deferral period, Roger, is over. Time to pay the tax. So Roger now has the benefit of those two reductions in the amount of tax. He's going to pay tax on $8.5 million. I assumed a tax rate of, say, maybe 28%. His tax bill at that point is $2.38 million. Instead of the $2.8 million he would have paid had he not had that reduction in the amount on which the tax was calculated. That nets Roger a net savings of his taxes of $420,000 via his participation in this program. Then, if he is able to remain patient and gets out to year 11, he's now held his investment for the minimum 10-year requirement, and he finds a buyer who wants to buy his new agency for $20 million. Roger, at that point, is really taking full advantage of this program, and his $10 million appreciation on his investment has a permanent exclusion from his income taxes. Roger retires to the islands. He makes a nice donation to his local Rotary Club, and things are good for Roger. So that's the first big win. But the second big win, and the one that Congress wants us not to lose sight of, is the benefit to our community. That economic activity, that business that got started, the jobs that were created, the homes that were able to be stabilized through employment, that is what Congress was driving at when this legislation was proposed and what Congress would like to see achieved. So, I think of these regulations as an iceberg. On the surface, above the surface, the rules seem fairly straightforward and simple. You put your money into an economically distressed community. Over 5, 7, 10 years, you get these wonderful tax breaks, and our lives are improved and our communities are improved. But below the surface of the water is where there are many technical requirements that have to be addressed and that have to be carefully observed if you want to get the full benefits of this program. And I'm going to try to address some of those to kind of illustrate the point. First of all, the technical requirements, again, have to be met at all 3 levels to receive the tax benefits. But I always encourage audiences, stay calm, try not to get lost in the weeds. For example, this Qualified Opportunity Fund, the vehicle, the investment vehicle that you use, it's simply a business entity that you assign a specific business purpose to. It is not some exotic type of entity or business construct. And then secondly, the requirement that you invest in assets within these zones is really a simple requirement to invest in either a business that is operating inside the zone or in certain tangible business property that qualifies for the investment inside the zone. All right, so the first level of technical technical requirements apply to the gain that we've talked about. And again, I want to reemphasize, the gain needs to be a capital gain. It cannot be some after-tax amount that you've saved over time that you want to deploy to get these tax benefits. That won't work. The gain also needs to be realized before January 1st, 2027. So that's an important time horizon to keep in mind. And you have to have the gain result from a non-related party transaction. So you cannot control the entities on both sides of the transaction that create the gain. A taxpayer who wants to participate in an Opportunity Zone transaction will make the deferral, make the IRS aware of his or her desire to make the deferral by filing this Form 8949 with their own tax return. That puts Congress on notice that you're not being a tax avoider, you're just simply taking advantage of this gain deferral opportunity that they've given you. Other thing that taxpayers should remember is that even as you participate in this program, the attributes of your gain remain the same. So for example, if it was a short-term capital gain, it will remain a short-term capital gain throughout the time that you're participating in the program. And also, although you're getting to defer your tax bill, there's no guarantee that Congress is not going to change the rate of the tax over the 7 years that your tax bill is being deferred. So there is somewhat of a gamble that maybe the low rate that's available today may not be quite as low 7 years from now when it's time to make the tax bill. So those attributes and those rate fluctuations are things that taxpayers should consider. The next technical series of requirements involve the investment inside of the Qualified Opportunity Fund. Again, the timing of the investment is important to adhere to. From the time that you receive the capital gain, in general, you have 180 days to find a suitable project and to get those funds inside of a Qualified Opportunity Fund. There are special rules for partnerships. If your gain is coming out of a partnership, you can either do one of two things. The partnership at the entity level can make the deferral and take advantage of the Qualified Opportunity Zone rules, or the partnership can distribute out the gain, and each individual member can make an election for him or herself. And if you get it out to the individuals, typically they have an additional 180 days to decide beyond the date that the entity, the partnership, would have had to make their own election. So there are ways that you can stretch out the amount of time that you have to find a suitable project and to redeploy that capital gain proceeds. An investment in a Qualified Opportunity Zone Fund, it must be an equity investment. That's important. You cannot simply loan money to the Qualified Opportunity Zone Fund. Now, this Qualified Opportunity Fund, this investment vehicle, the IRS says it has to be a partnership and a corporation, and interestingly enough, it can self-certify. There's a form, and of course the IRS has another form, Form 8996. The entity would file that form indicating that it has been self-certified to be a Qualified Opportunity Fund. And to do that, the purpose clause of the organization, you would say, we've been organized for the purpose of investing in Qualified Opportunity Zone property. And the other technical requirement is that once the Opportunity Zone Fund receives those proceeds, 90% of those proceeds, 90% of those assets must be redeployed into what's called Qualified Opportunity Zone property. And that must be measured and certified semi-annually, basically every 6 months. The third level of making a decision to invest in a Qualified Opportunity Zone Fund is that, again, 90% of the assets must be deployed into what's called Qualified Opportunity Zone property. A little footnote here, Again, with this requirement that 90% of the assets be deployed, Congress has said if you don't meet that test, there's going to be a penalty. But you would have thought that if you had 3 strikes, you might be out of the program completely. But Congress has not said that. So it's not clear how many times you can fail to meet this 90% test before they will boot you out of the program completely. But so far, there is no number of times that you can fail that test. Now, Congress has given us 2 ways that we can invest in qualified opportunity zone property. The first method is what we call indirect investments. You can purchase the stock, or you can purchase a partnership interest in a partnership that is, in fact, a qualified opportunity zone business. So there's the indirect method. Or if you prefer, you can take your capital gains and make a direct investment in qualified opportunity zone business property. If you go with the direct investment, the technical requirements kind of crank up a little bit more. The opportunity zone business property has to satisfy 2 additional tests. One, the property, first of all, must have an original use inside that zone at the time you make the investment. That means it cannot have been used by any other taxpayer before you make your investment. So that means, 1, you can come in and construct your own property in the zone, or 2, if you bought for instance, a building that was partially completed, you could complete it, and that would also qualify as an original use because no other taxpayer had deployed it for original use. The other way you can satisfy this direct ownership test and have it qualify as opportunity zone business property is to substantially improve an existing property. Now, the definition of a substantial improvement would require you to invest in that property at least as much as your original basis in the property. Otherwise, the IRS will say that would not qualify as a substantial improvement. The other nuance, though, about original use of a property comes into play when we talk about properties that have sat vacant for some time. If the property was vacant before it became in part of a qualified opportunity zone, once it becomes a qualified opportunity zone, if it had been vacant, you get, within 1 year after it becomes part of the zone, you can treat it as original use. If, however, the zone is established, and say 2 months after the zone is established, the property becomes vacant, it has to sit vacant for 3 years before the IRS will say it qualifies as an original use. So again, as you can see, there are many, many paths that you have to navigate successfully to capture these benefits that the taxpayers are seeking. So this is just a diagram of what I've just described. At the top is our Qualified Opportunity Zone Fund. Going down each side are the 2 indirect investment opportunities that you have, either through stock of a corporation on one side or a partnership interest on the other. If you go straight down the middle, you have your direct investment opportunity where the fund itself would own the underlying assets or the business. All right, I want to make sure I leave a few minutes for questions. So let me quickly step through this slide. So why are opportunity zones so interesting? Well, one, they're popular because they have bipartisan support. So you don't hear really anyone out there on either side of the aisle bashing them. They're flexible. They allow the taxpayer to make his or her investment either directly or through these wholly owned subsidiaries. They're scalable. There are no caps. There's no limit on the amount of money that a person with capital gains can invest in these projects. There's very little oversight. That's why we call it the Wild West. There is no federal department of opportunity zones that you have to report to. This is one of the few times that Congress has instituted a program that has large-scale economic impact without setting up a equally complicated regulatory oversight scheme. It's a new source of capital that's been freed up. And for communities that have received this designation of an opportunity zone, it becomes a very important sales point for them as they try to attract capital. Ohio, our state, has also provided one additional incentive at our state level. If you invest in Ohio Opportunity Zone, you can receive a tax credit up to 10% of the amount that you're investing in that Opportunity Zone with an upper cap of $1 million. So again, as I said, this is a national program, so other states are also competing for these capital gains reinvestment opportunities. So many states, such as Ohio, have added their own inducement to try to get investors to choose Ohio as the place where they want to deploy their capital gains. And this is just a quick summary of some of the important dates that I've talked about as we move through the discussion today. The important dates to remember that on December 31, 2026, any deferred gain will have to be recognized. And all the Opportunity Zone designations will end on December 31, 2028. And looking way down the road, by December 31, 2047, if you're still holding on to an Opportunity Zone investment, you must dispose of it by that time. A few resources for those who would like to know more about this whole area. I put those there. The bottom one is a website run by the Ohio Department of Development. It has a lot of important information about projects here in Ohio that are been presented as being ready for Opportunity Zone investment, and a description of the project and also the contacts that are available. And so with that, I would be happy to entertain any questions. I see a hand in the back row. Yes, sir.
Hey, Michael. Mike Rankin.
Hey, Mike.
Thank you for your presentation today, but as you were speaking, I was looking up New York Times, National Public Radio, and other news outlets have reported that a number of House and Senate elected officials in Congress are wanting to repeal some of these zones because they aren't in impacted poor areas. They're in gentrified areas or areas that simply are wealthy areas. So will that affect the future of this program?
Mike, thank you for that question. You're exactly right. There is some dissatisfaction in Congress, and I think also in the general community about what people perceive as an abuse of this program. I think that's why you've seen a large rush for investors to get in before there's any additional legislation that would alter these rules or even end the program completely. I believe if you're in now, Congress will allow you to ride it out into the future. But I do think there's going to be a call for more transparency in terms of where the dollars are going, what communities are benefiting from them, because right now there is no even method to collect who's investing in an Opportunity Zone. There, like I said, there is scant oversight by the government at any level of these projects. It's really an investor-driven set of initiatives, and some people are afraid that impure motives are driving it in directions that it wasn't intended. All right. Well, yes, Rick.
I have a feeling a lot of us would be really interested to know one or two examples, real specific examples in the Columbus area where this is active. Particular neighborhood, particular property, what's happening?
Well, as a lawyer, you have to be careful about client confidences but I am seeing, have heard and been observing that, West Franklinton is going to be an active pocket of activity because of its location being adjacent to East Franklinton, which is a hot area. I think you're going to see areas around the 315 corridor. You see, because of it's as a healthcare corridor, I think you're going to see a lot of people take advantage of Opportunity Zones there also. And I think other areas such as the Near East Side, which already has some other incentives that have been introduced by the city of Columbus, but I think layering this on top of that will also spur additional investment in that community. Yeah, Rick?
Yeah, the only one I've heard about from other commercial brokers, there was a building in Bush that sold in that continent area
Right.
that he talked about 3 or 4 weeks ago. That is the only one that I'm aware of.
Right. Right. Like I said, because these are so private transactions, you don't have to report them. And they can be done privately without anybody being aware of them. So it's hard to track them necessarily, but I do believe there is broad interest still in Central Ohio and beyond in this market. I think my time is up. Thank you. You've been a great audience. Thank you.
Thank you, Mike, for that presentation on the opportunity zones. So we'll be looking forward to seeing you all in 2 weeks. Our speaker in 2 weeks is Abby Fisher from Big Brothers Big Sisters of Central Ohio, the Vice President of Programs. So we look forward to seeing you there, and thank you all for coming today.